to the Finance Committee meeting of November 24th. Councilmember Horton is not here today, nor is Councilmember Falcone. You got me today as chairing, Helene Schneider, and Mayor Bloom as the alternate, so we do have a quorum for the Finance Committee. We have one item on today's agenda, which is the October 2009 investment report, and I'll just turn it over to Bob.
Thank you, Madam Chair, members of the committee. Bob Samario, Interim Finance Director. And as you know, each month we bring to the Finance Committee and Council a report on the investment activity. And today we're going to be covering the month of October 2009. And just kind of by way of background, since these reports tend to be a little bit mundane, but I wanted just to kind of give you some insight to the fact that, this is a really tough interest rate environment that we're investing in. Interest rates are at historic lows. The federal funds rate is about 0 to 0.25% right now, which is the lowest it's been, I think, in history. And our two-year treasuries, which sort of as our benchmark as to where we invest in, are right now at about just over 1%. And I wanted to show you kind of the environment we're in. And to me, it's pretty interesting when you see the history of the interest rates for the two-year treasuries. And this is just at a point in time each year in June because it's a monthly rate. But you could see back in 2000 that the rates were 6.36%. And then it bottomed out just after the September 11 events, terrorist attacks. And you could see they got down to 1.3, and then, of course, they just went right back up as the economy started to improve. And now, in the last couple of years, they've gone down quite a bit. We're down to 1.1%. Now, I want to kind of juxtapose this against our interest earnings. And the next chart really just shows the general fund only, and you can see how the revenues track with interest rates. And I'll kind of make an observation about it. But you can see back in 2001, we were making $2.8 million, or we made $2.8 million in the general fund. Notice that in 2005 is when we saw the bottom as a result of 9/11, whereas the rates dipped in 2003. And the reason for that is because our investments are typically 2 to 3 year in terms. And so it takes a couple years for the interest rates to start impacting our investment portfolio and our interest earnings because as those things mature over time, then we start reinvesting in a lower interest rate environment. But you can see that for 2010, we have budgeted just $637,000 in interest earnings for the general fund, over $2 million below what we were in 2001. The bad news is that because things still are lagging, interest rates are going to be low for the next 6 to 12 months, some predicting even more. Because the economy is going to expect it to be recovering slowly. Interest rates will still be down. That number will likely go even further down as we're starting to see those securities that are 2-3%, they're going to start earning 1%, maybe less than that. So that's the environment we're in. But I do want to point out that we really don't change what we do, our approach to investing. We still have to buy into the market. We're always focusing on safety and then liquidity, and yield is the last thing we really focus on. There isn't much we can do to improve that. We're typically buying, again, 1% paper, 2% paper. Perhaps once in a while we'll see a callable security we can get maybe 2.5%, but we expect it to be matured or called in 2 or 3 months or maybe 6 months. And the rest of it is just parked in our LAIF account, which is earning currently about 0.65%. So not a lot of options. So just with that, I wanted just to go through real quickly what the activity was for the month. And you can see up on the overhead, we had a total of $18.5 million in deposits. The vast majority of that was the deposits we made into LAIF. You could see on 10, 15, 16, and 20, we deposited monies into LAIF. And that typically coincides with monies that come in, and we still want to maintain some liquidity, so we'll park it into the LAIF account. Down below, you can see we have almost a corresponding number of withdrawals from LAIF, again, just managing cash. But in terms of investments, up on top, we did purchase about $6 million in securities, Federal Farm Credit Bank and Federal Home Loan Mortgage Corp, and then a Fannie Mae. And in terms of maturities, we had about $6.3 million in maturities. You can see 2 of those were actually callables. Those are the ones we purchased. We expected they'd be called. They had a 6-month call provision, and you can see they were, in fact, called, but at least we got higher than what we would get on a 2-year treasury or even a LAIF, of course. So that's really the activity. If you go to the right more, you can see our interest earnings for the year. And this is just for the month of October, $363,000. Now, of course, this is the interest earnings on our entire portfolio across all funds. The general funds portion is, of course, much smaller than that. And then down below, you can see what the RDA earned, $11,600 in the LAIF account. That's just for 1 month, so you can see their interest earnings are well below what they've been in the past. And just to kind of take a look at what our current portfolio looks like in real summary form. If you just go down to the bottom, primarily, it shows both last month and then this current month, but if you could see that we have about $44.6 million in LAIF. Most of that, about $25 million, is related to the RDA. Essentially, we park most of its money, if not all, in LAIF. The balance is related to the city. We do have a $2 million CD. It's actually has a 2.5 interest rate coupon. The rest is, or at least the vast majority of the rest, is the federal agency issues or securities, $96.9 million, currently earning on an average basis $3.3 million. And that's kind of what I alluded to before. As those start to mature, we're going to see that rate go down over the next year or so. We do have some corporate medium-term notes paying actually close to 5%. Again, those will mature in the near future, but we have about $10 million in those. And then lastly, as you know, we have that promissory note with the Santa Barbara Airport, $7.3 million. We do have a small balance of $3.5 million in our money market account. That's just money we have to maintain a minimum balance of about $2.5 million for the bank. And so that balance will go up and down. You can see last month it was about 2.8. It just depends on cash flow. So with that, I'd be happy to answer any questions.
Do you have a question?
No, pretty straightforward.
Okay, I have one question. On the corporate medium-term notes, you mentioned if you look at the rate, it is a much higher rate than the others, and two of them are coming up. Their maturity dates in January and March. Do we expect those interest rates to be as far down as the federal agency coupons, or are they still slightly higher? I mean, what is...
Yeah, the corporate notes, they pay a little higher. They're closer to the 2% range right now. But we'll be looking closely at, as you know, right now the economy is not doing great, so investing in corporate notes, we have to be a little more careful, make sure that they're properly and adequately graded in terms of from rating agencies.
Right.
But yeah, we're looking more at a 2% range. If we invested in federal agency securities, it'd be more 1.5% range.
And does our policy require a certain value that goes towards corporate? No, I don't remember. So
yeah, our policy provides or establishes certain limits as to how much we can invest
a maximum,
in
not a minimum. Okay.
For corporate notes and even callables. For corporate notes, I think it's somewhere around the 20% range, and for callables, I think there's a suggested 30% range we don't want to exceed.
Okay. Okay. Well, it's a typical monthly report, and so with that, I'll entertain a motion to bring it to council.
So moved.
I'll second that. All in favor? Aye.
Just to note, this is going to be on the consent calendar for council.
Right.
Right.
That was easy. Thank you very much. This meeting's adjourned.